The sales comparison approach is a widely used method for estimating the value of a property by comparing it to similar properties that have recently been sold in the same vicinity. This approach is grounded in the idea that buyers will pay no more for a property than the cost to purchase a comparable one with similar features and utility. To use this method, an appraiser first identifies a set of recently sold properties, known as comparables or comps, that are similar to the subject property in key respects, such as location, size, number of rooms, age, and condition. The appraiser then carefully examines differences between these comparables and the subject property, such as whether one has a balcony or a swimming pool while another does not, and makes appropriate adjustments to the sales prices of these comps to reflect these differences. After adjusting for these differences, the appraiser averages or reconciles the values to arrive at an estimated market value for the subject property. For example, imagine valuing a 3-bedroom apartment in Delhi. Suppose 3 similar apartments nearby have recently sold for 95 lakh, 97 lakh, and 98 lakh. If the subject apartment is slightly smaller and lacks a balcony that the comparables have, the appraiser will adjust the sale prices of those comparables downward to account for those differences. After making adjustments, the average adjusted price might be around 96 lakh, which becomes the estimated value of the subject apartment. However, the sales comparison approach has some key limitations. Primarily, it only reflects past sales data and physical features, ignoring any potential future income the property might generate if rented, for instance. It also assumes that there are enough similar properties recently sold nearby to make meaningful comparisons, so it becomes less reliable in markets that are volatile or for properties that are unique or have unusual features. When there are few or no good comparables, or when markets are rapidly changing, this method can produce less accurate valuations. In contrast, the discounted cash flow, DCF, method values a property based on the present value of all expected future income streams it can generate, discounted back to today's terms using a rate that reflects the risk and time value of money. Unlike the sales comparison approach, the DCF method explicitly incorporates future income potential and adjusts for risk and cash flow timing. For example, while the sales comparison method would simply adjust for physical features, the DCF method would consider how future rents might grow, possible vacancies, maintenance costs, and changing market conditions over the investment horizon. This makes the DCF approach more dynamic and suitable for income-producing properties, especially in commercial real estate. In summary, the sales comparison approach is best suited for residential properties with many similar, recently sold counterparts nearby, providing a snapshot based on recent market behavior. The DCF method, on the other hand, is a more complex, forward-looking valuation that better captures the investment value of properties by accounting for the timing and risks of future cash flows. Depending on the type of property and market conditions, appraisers or investors may use one or both methods to gain a fuller understanding of a property's value.